Okay, so I'm going to be taking you through retirement lump sum funds, learning unit 11. So I just have a bit of a quick motivation, which says, believe in yourself, you're braver than you think, and you're more talented than you know, and you're capable more than you can imagine. So that's the motivation that I'd like you guys to carry with you for the next coming weeks and throughout your studies. So we have different types of funds. You have your pension fund, and it is a fund that will be set up by your employer for the benefits of the employee. And the objective of this fund is to provide annuities and a lump sum for the members upon their retirement. And the second fund that you have would be a provident fund, which is a fund that is set up by an employer for the benefit of its employee. And the objective of this fund is also for the cash lump sum upon their retirements. And you also have a retirement annuity fund, which is set up. Let me just move this, which is set up by an administrator or insurer for the benefit of an individual. Retirement annuity funds are taken out in the name of the individual member. They encourage members to save further amounts for their retirements over and above their contributions to an employer's pension fund or their provident fund. So this retirement annuity fund would be the fund that an individual decides to get for themselves outside of what their employer would get for them, which is the provident fund as well as the pension fund. You have a preservation fund, and this is when members leave a retirement fund before their retirement date. Their contributions can then be transferred to a preservation fund. There are only pension preservation fund and provident preservation funds. There are no additional contributions that can be made to the preservation fund by the taxpayer. Right? So let's just dive into the tax consequences that would happen in a context of retirement lump sum funds. So the contributions that an employee makes towards a retirement fund, a pension fund, or a provident fund will be deductible in terms of Section 11 Cap F. Are you familiar with Section 11 Cap F, finally?
Yes, I did. I kind of went through a bit of it last week.
Okay, yes. So when an employee contributes towards the above mentioned fund, being your provident fund, your pension fund, as well as your retirement fund, they will get a deduction in terms of Section 11 Cap F. And there is no distinction between these funds in terms of tax treatment. So your contributions, when you calculate your total contributions, they can be contributions that you make towards your they can be contributions that you make towards your retirement annuity fund or the contributions that you make towards a provident fund. Section 11 Cap F is also, you can also get Section 11 Cap F on the contributions that an employer makes for an employee, and those would be your fringe benefit. I don't know if you would have went through fringe benefits as yet. So when yes, okay, thank you. So a provident fund or a pension fund fringe benefit would be a scenario or a case where your employer contributes towards a pension fund for your benefit. So that contribution that is made by the employer, as you know, you would include it in your gross income in terms of paragraph E, and calculated the actual value of the benefit in terms of the 7th schedule, and you will consider it in your Section 11 Cap F deductions. It will be part of the total contributions. And it is important to remember that an employer can get a deduction in terms of Section 11I for the provident fund contributions that they make on behalf of their employees. And this is the part that speaks into the contributions that would have been made by an employer on behalf of their employee.
Sorry, can I just ask something? The
Yes,
contributions, the part at the top, that 11, the section 11F,
yeah,
would be against the individual. Would those be would
yeah,
those deductions be against the individual? And then the section
yes,
11I would be the deductions against the company or the entity.
yeah, the employer. Yes, that's correct. Yeah.
Oh,
So okay. So you have your retirement lump sum. So these are the lump sums that you get. So maybe let's say a person would have reached retirement fund and then they get a lump sum of like 1 million or 2 million. These are the lump sums that we are talking about. So those lump sum are taxed in terms of the second schedule and not your gross income. So they have a separate tax table. You calculate the tax on those lump sums from these funds that we've discussed above using a separate tax table. Do you have any questions finally?
no, nothing so far.
Okay. So this is the tax treatment for a lump sum versus an annuity. So normally when you have a retirement annuity fund or like a pension fund, after an employer has um, finally reached retirement age, they obviously get a lump sum as well as a annuity. So the annuity would be that maybe according to that fund, they get 1.5 per month. So that 1.5 per month that they would get, it would be taxed in terms of paragraph A of the gross income definition. You include the annuity from that pension fund or the above mentioned fund in terms of paragraph A, and the actual lump sum that has been paid out, it needs to be considered in terms of the second schedule, meaning that it will be taxed using a different tax table per the second schedule. Are we still comfortable?
Okay, so are we saying the annuity is the monthly payments and the lump sum
Yeah,
out is the whole amount?
yeah, yeah,
So
it's
when
the
you
whole.
just to double check, the annuity, if it's because it meets the definition of a gross income, the
Mm.
monthly payments would be thingy for tax, would be
Yeah,
taxed. Oh,
they will be included in terms of in your gross income in terms of paragraph A of the gross income definition. But you should know that when we are going to do a question and it has these
mhm.
scenarios in them, so it will be easy
Okay.
to
Now, I'm
understand.
just wanting to make sure that I'm understanding the basics of what an annuity is and between
Yes,
the difference
yes.
between the two. Okay.
Yes, yes.
Okay, I get you.
Obviously, the annuities that you get from that retirement fund, for example, do meet the definition of an annuity because it's a continuous payment that you
Hmm.
get. So it does meet the definition of an annuity, and it should
Yeah.
be included in your gross income as such.
On
And
another,
that,
mhm. Carry on.
yeah, you can continue. It's fine.
No, no, you were saying, and that's so you can continue because it might be answering what I was gonna ask.
So, and then your lump sum, which is that large capital payment, would be taxed using a separate tax table. So it will not
Hmm.
be included in your gross income.
Okay. So an
Yeah.
annuity, we're still talking about the retirement annuity, the one that you can get from your old mutual and stuff like that, or we're talking about ones
Yes.
where, for example, in the government sector, you have that portion where you can take out without the interest, and then you every single month you can get like a monthly payment from your pension when you retire, that option, or are we talking about only the one from like the private banking or insurance institutions?
So we are talking about because you can have different annuities.
Mm.
You can have annuities that you get from your what is this? Your lump sums, your
Yeah, that's what I
retirement
was because with the
benefits.
lump sum one, would that be what government when a government employee retires and then they opt for the option of not getting all their money at once, but they get like a
Mm.
I don't know, is it like a capped at 350 or whatever the amount is, and then the rest on is monthly payments? Would that fall under lump sums or
Yeah.
would that fall under annuity?
So I don't know if you're familiar, but like there was so you're not allowed to get all your lump sums. Like if, let's say, for example, your value of your retirement annuity fund is like 2 million, you're not allowed to get all of it as a lump sum, meaning get it as like a total cash benefit. I think you're only allowed to get 1/3 of it as a lump sum, but
Yeah.
I'll confirm. And then
Okay.
2/3 of that you have to get as an
As a
annuity.
monthly.
So yeah,
Okay.
as
So that that 2/3 falls under paragraph A.
yes, that
And then
2/3 falls.
and then the 1/3 falls under Schedule 2. I mean second
Yes,
schedule.
under Schedule 2. Yeah, that's
Okay.
how it goes. So like
Okay.
I remember I read about it, the reasoning behind them giving us like giving a person upon their retirement age only 1/3 as an annuity, as a I'm sorry for that, as a lump sum, and giving 2/3 as an annuity is so that people
Mm-hmm.
don't rely on government grants a lot, so that their
Mm-hmm.
retirement funds can actually carry them throughout their lives when they after they retire. So that's the thinking
Okay.
behind it. Yeah,
I
it's
get you.
I mean it has no tax consequences, but it's just like an interesting fact to know.
Okay. And then just on another note, I want to find out what would I'm assuming that the contributions throughout the years before the payment is made is was that also taxed? Because I've always been confused about that. Is that also taxed or not taxed? Reason I'm asking is because if
Mm,
the annuity gets taxed and it falls under gross income every month after you've been paying for the couple of years,
mm.
would
So
that not be like a double tax? So you taxed while you're paying and you taxed also while you're having the payout. So how does
mm. So you get, if you could remember when we were discussing up here, so you
mm-hmm.
get a deduction for the
Okay.
contribution that you make, right,
Okay. Now I get
to your funds.
you. To fund,
And
yeah.
then yeah, and then your annuities, the returns that you get from that fund, which would be your annuities as well as your
Mm-hmm.
lump sums, they also
Mm-hmm.
get taxed. Yeah. So
Okay.
it's
No, okay.
not really a double. It's not like you're being taxed twice, like because that
Uh-huh.
amount was never like you just got a deduction for the
Yeah.
contribution. Yeah.
For the so you like being incentivized to contribute.
Yeah, it's technically just like a scheme to incentivize people to contribute to their retirement funds.
Okay. Okay. Thanks for
Yeah.
that.
And then you have your restraint of trade. I think we also dealt with this when we were, I'm not sure if you would have caught up with that, Fanele, but we had done restraint of trade straight when we're doing special inclusions.
Mm-hmm.
So a restraint of trade is an amount that has been received by or accrued to a labor broker or a personal service provider, or an amount that has been received by or accrued to a natural person. So, in the context of a labor broker or a service provider, the restraint of trade will be included in their gross income in terms of C cap A. And in the context of a natural person, it will then be included in terms of 6 cap B. And then this is obviously an amount that is received from an employer on termination of employment to not undertake in certain occupation. This amount is capital in nature, but it is a specific inclusion. And the employer can get a deduction in terms of Section 11 C cap A. So in my notes, I wrote employer as ER. I hope you don't mind.
No, it's fine.
Yeah. So let's move on to compensation for loss of office, and this would have also been dealt with when we were doing specific inclusion. So compensation for the loss of office is any amount, including voluntary awards received or accrued by an employee or a dependent of that employee in respect of a relinquishment, a termination, loss, repudiation, or cancellation or variation of employment. So the trigger when you're dealing with compensation of office amounts is that there needs to be bulletproof 3 needs to be met. It needs to be your trigger. There needs to be a relinquishment, a termination, or loss of work. And as a result of that loss of work or like a cancellation or variation of office, the person has to receive an amount from an employer. And that amount will then be included in their gross income in terms of paragraph D as a specific inclusion. Are we still together?
No, I just got lost a bit there.
So, okay, no problem.
Would you mind giving me, like, for example, it's compensation for loss of office for paragraph D? And any amount excluding annuities, including voluntary award received or accrued, would that be for like when they say voluntary award received or accrued, would that be like a long service thingy or not?
So I think it would be in the context, because I remember like years ago, there was a lot of retrenchments that were happening in mining around mining employees.
Okay,
And they
okay,
would
okay.
have the option to take money
I
for
think
yeah,
Also,
yeah,
it's retrenchment packages.
in a way, but it's voluntary. It's a voluntary award.
Okay, that's where I was, because I was getting
Yeah,
confused with the voluntary. So it's, I think also Transnet did that a couple of years. They think they did that recently, where
yeah.
they offered instead of the older employees taking, who are closer to retirement, taking out retirement. Instead, they were offered like a lump sum to take that, and almost like a voluntary resignation kind of thing. Not really resignation, but they would obviously sign a contract to terminate the employment in that way, compared to terminating it where they get the annuity and the lump sum.
Yeah, that's you have
Okay.
it spot on. Yeah, that's something
Okay.
I like that. Your
Okay.
questions are very interesting.
Sorry,
And
I'm trying
then,
to add two and two together so that even if we
yeah,
do the
no,
example, I know
yeah,
what the contents of that particular section is.
yes. No, it definitely helps. I think you're asking the right questions to be able to understand the content. Yeah, and then we have any amounts that are received in respect of in commutation of amounts due under any contract. Commutation is like substitution. For example, paying out an amount instead of providing a notice period or a termination of service by employer. And all these three amounts that I've discussed, the restraint of trade, your compensation for loss of office, as well as compensation for commutation in terms of paragraph F, are not lump sums as discussed. Okay. And then you have a severance benefit, like in university all the time when my trigger for identifying if there has been severance benefit was that as soon as I read a question and I see the person is older than 55 years old, I start to think about severance benefits. So that's just one thing that I just want to let out there. So a severance benefit is any amount that has been received or accrued in respect of a relinquishment, termination, loss, repudiation, cancellation, or variation of any office of any office or employment of any appointment or any appointment. So what I'd like to say also is that severance benefits and paragraph D are closely linked, right? So that the difference, what would make one not have a severance benefit but a paragraph D compensation or loss of office would be the requirements. So they kind of have the same definition. It's just that with the severance benefits, the certain requirements that needs to be met. That amount has to be paid to any person who is older than who is 55 or older, and the person should have become permanently incapable of holding his or her office due to sickness, injury, or incapacity through infirmity of body or mind, or the person's employer has ceased to trade or made a general or specific reduction in personnel, excluding retirement annuity funds. So this amount excludes, these severance benefits excludes retirement annuity funds, retirement fund lump sum withdrawals, and the two policies of insurance in terms of paragraph D of the gross income. Are you still with me?
Would the severance benefit be like when someone's being medically boarded?
Where somebody's being medically what?
Boarded, because they can't work anymore, but they because of
Yes.
illness.
Yeah. So a person can't like continue providing a service because of an illness, or it's because,
mhm.
or it's
Yeah.
also because they are older than the age of 55, or the employee has ceased, the employer has ceased to trade, or has made a general reduction in personnel.
Okay.
Yeah.
Oh, hold on. When we, because medically boarding can be at any age, would that fall under here or another one? Because obviously that will also shift because they're not getting any
So
payment.
it would fall under here because this is an OR test. Not all these requirements have to be met. As soon as like there
Okay.
has been an amount that has been paid as a result of a termination loss, etc., and it meets one of these requirements, then it would be a severance benefit.
Okay. Okay.
Yeah.
Okay.
And then you have your lump sums for paragraph E. So in terms of there's a gross income specific inclusion line item where it says your lump sums from your retirement funds must be included in your gross income in terms of paragraph E, right? And these retirement funds are affected by the second schedules and paragraph E of the gross income. The lump sums are your pension fund, your pension preservation fund, your provident fund, your provident preservation fund, and your retirement annuity fund. So a bit of an exam technique. When an employee gets a lump sum, that 1/3 that we spoke about, when an employee gets that lump sum, you need to show the marker that you know your work, right? And you need to include that lump sum in terms of paragraph E, and then subsequently less it and say that this is text under a separate text table to show the marker that you know that your lump sums are text under a different text table and not your normal text table. I hope I didn't confuse you.
You have. Can you give me like a small example of how would you word that? Because I just got lost.
Okay, so let me just put the example here, right? So e.g., right, a person receives maybe 2 million lumps, a lump sum of 200. Let's make it 2,000, not make it big. For exam
Okay.
technique purposes, because the gross income, like specific inclusions, paragraph E do say that you need to include the lump sum from a pension fund. You would then say pension fund lump sum. I'm just gonna name it LS. Lump sum. You include it in terms of paragraph E in your gross income. Obviously, you would be calculating your gross income. You include it. Okay, you include it in terms of paragraph E at that 2,000 value, and then you then subsequently less it and mention that text under a different text table. Then you just less it. So your like the effect of this lump sum would basically be nil in your gross income or your taxable income, because you're gonna calculate tax for that lump sum under a separate tax table.
Okay. Okay.
Yeah. So your retirement fund lump sum, fund lump sums as defined in terms of section 1 is an amount that is an amount determined in terms of paragraph 2 1A of the second schedules, which is any lump sum received or accrued in consequence of retirement or death, loss or termination or loss of employment, and commutation of an annuity or a portion of an annuity. So that those would be the amounts that you include in your retirement lump sum value in terms of paragraph 2, which will be easier when we do the question. So, but I can just like say an example. Let's say, for example, a person has received a lump sum of 200 as a result of them being in their retirement. Then they would have to include that 200 in terms of paragraph 1A, because it's the value of the annuity that they actually received. Are we together?
Okay. Yeah. No.
Okay. And then the person, the taxpayer, can then get deductions in terms of paragraph 5. So this is almost like a mini gross income, taxable income calculation. So you include your lump sum that has been received, and then you can get deductions. So the taxpayer can get deductions of their own contributions that were disallowed in terms of section 11 cap F. So contributions that were disallowed in terms of section 11 cap F, you have to list them from your lump sum. Let's say, for example, in the context of our example, that lump sum of 200 Rand, and then they had previously disallowed allowances in terms of, they had contributions that were disallowed as an allowance in terms of section 11 cap F of 10, then from that 200 you would have to less the 10 because it actually meets this criteria. And then another deduction that they can get is any amount that has been transferred for the benefit of the taxpayer to another fund as a result of an election by the non-member spouse. You know, like during divorce orders, how people move, how you can sometimes get your ex-spouse's retirement lump sum. This is the situation. So that divorce order transfer of funds from your retirement fund or your pension fund to your ex-spouses would be a deduction, which makes sense because you technically did not get it. Why must you now be taxed on something you didn't get?
Okay, that makes sense. Yeah.
Yeah. And then an amount transferred for the benefit of a person which is deemed to have accrued to the person on the date of transfer. So from any fund to any fund of which a person was previously a member. So like a fund to fund transfer is also a deduction on that lump sum.
Fund to fund transfer.
So like
Would that be
transferring
when someone retires or resigns? I mean, and then instead of taking the funds, they transfer it to what
another
should they say,
fund.
preservation fund or something like that.
Yeah, preservation fund, or also like another fund.
Oh, okay.
And then other deductions would also be an amount to the extent that it was paid or transferred to a preservation fund or a provident fund as an unclaimed benefit if it was subject to tax prior to the transfer or payment. And the exempt portion of a public sector pension fund in respect of service years before that mentioned date. You also have paragraph 6 deductions, which are similar to your paragraph deductions, so I'm not going to go through them. And this is your retirement fund tax table. So this is the table that you use to calculate tax on the retirement funds. It doesn't matter if it's a severance fund, if it's a pension fund, if it's a retirement annuity fund, or if it's a provident fund. They are all taxed under this tax table. Are we together?
Yeah, we're together.
Okay. So just as a purposes of revision, I just included purchased annuities. So purchased annuities would be the annuities that a person buys. In the context of an exam, they'll tell us that we have person A who's purchased an annuity for 100,000. So the annuities that they receive then from that purchased annuity will be subject to an exemptions in terms of section 10. All right, and we will have an example and we will have a question that deals with this in our tutorial. So we'll go into the details, but just remember that this only applies to a purchased annuity. That the tax treatment would be that you include the total annuity that has been received. Let's say, for example, that person received 1.2 per month for like 12 months. You include those total annuities that have been received, and you have to deduct a capital portion from that. The capital portion is calculated as the capital investment divided by the total annuities that you're going to get for the entire period of the annuity, multiplied by the annuity that has been received in the current year. So this would be how the formula would go to calculate the capital portion of the annuity. You take the capital investment divided by your total annuities that you're going to get throughout the lifetime or the period of the annuity, multiplied by C, which is the annuities that have been received in the current period.
Okay.
Are you still with me? Yeah. So we then have our tax tables. I just thought I should include them. Tax tables, and then your rebates and your tax thresholds. Okay. So now we can move to the question. Are you comfortable with what we went through in the notes, or do you have any questions?
So far, I'm comfortable. I think I'll probably get, if I come up with them while we're doing the questions, just to clarify some stuff.
Okay. Please give me a second. I just want to get my notebook. Okay. And we can start. So you have Philip Mhlongo, who has worked in SARS for the past 25 years. So one thing I just like to do in my tutorials every time is just to mention that every time when you are given a text question and then you see that you're dealing with a natural person, you should be thinking in your head about all the provisions that apply, all the tax laws that applies to natural persons, the fact that they are taxed on the tax tables, their medical aid rebates, as well as your primary rebates and any tertiary rebates that they might qualify for, like anything that relates to a natural person. The fact that they're also able to get an interest exemption. So that's something that you should do in every question that you practice, so that you can be able to be constantly revising your work. And then prior to his employment, he worked for an accounting firm for 15 years. Philip has been very ill for the past year. On the 1st of December, he retired from SARS due to ill health. So we know that this is sort of like a trigger. You may assume that as a result of this illness, Philip was a person with disability as defined. So they've told us that Philip was a person of disability as defined. This is going to affect Philip in the context of section 6 cap B, medical rebate. Were you saying something?
No, I was actually saying 6B.
Yeah. So it will affect this person in that context. He turned 60 years, so older than 55, and excuse me, he turned 60 years of age on the 18th of August 2023. And Philip had the following income and expenses for the year. So he had a salary of 210. So that should be included in your gross income in terms of paragraph C. Salary is included. And a pension annuity that has been received after retirement, that is also included, as we said, in terms of it's an annuity. So it should be included. And long-term, long service awards cash that has been received, as well as a lump sum from a pension fund. So this long-term long service cash will be a fringe benefit. So we need to read more on it. It says here, on the date of his retirement, Philip had worked for SARS for 26 years and 9 months. He therefore qualified for a long service award, which SARS pays out after a person retires after more than 10 years. Philip also received a lump sum from the government pension fund on the date of his retirement. On the date of his retirement, all his pension fund contributions over the past 25 years and 9 months to the fund have been made by SARS based on his salary. Philip was not required to contribute to the fund. The current year pension fund contributions for the period were up to date were 34,000. So this pension fund was contributed by SARS based on his salary, and Philip was not required to contribute for this. So this is a fringe benefit because it is contributed by SARS on behalf of Philip. Are you comfortable with that?
Yes, I'm comfortable.
Okay. So now we know that he has a fringe benefit of this 34,000. And he also had a long service. Excuse my spellings if they're not correct. Of 5K. So that should be included in his gross income as a fringe benefit. So he also then had a lump sum from his pension fund. Like I said, you should show the taxpayer that you know that this is going to be taxed under a separate tax table. And he had medical aid contributions of 24,452. And they explain down here, Philip contributes monthly from his salary to MedBest medical aid on behalf of himself and his wife, and they are married out of community of property. He contributed he continued to contribute the same amount after his retirement. SARS contributed 5% per month to the medical aid up to the date of his retirement. So you also have a medical aid fringe benefit of 500 up until the date of his retirement. And you have insurance premiums. So Philip pays insurance premiums, and it does mention here that Philip contributes to an income protection policy. The proceeds will not be taxable when paid out. His contributions ceased on the day that he retired. So, trick question, do you think that these insurance premiums are going to be deducted? on his gross income.
The one for the income protection policy.
Yeah.
If I'm not mistaken, wouldn't it be deducted because it's for his employment, to protect him from
His employment.
beneficial from his unemployment, yeah.
Yeah. Your thinking is getting there, but in terms of Section 23, you are not allowed to get a deduction if it is not in the production of income. So, but by virtue of them saying that the proceeds that he will get from the payouts that he will get from this from this income protection policy will not be taxable when paid out, it means that they are not in the production of income, as the premiums do not yield a taxable income. So that's how you're supposed to think about it. Every time when a person makes a contribution, when a company pays towards something, if it is not going to result in taxable income, it's not in the production of income, therefore will not be allowed as a deduction in terms of Section 23.
Okay, and then which one would be allowed when it comes to a premium? Would that be, because that also would, I'm assuming this type of policy, the income protection, would also be similar to his life policy, if he pays by himself, or would that, if the company also contributed to the life cover or life policy, would that be deductible if he was a partner, for example?
It will not be deductible because it doesn't result in any the payouts that you get from a life cover are not taxable on your are not taxable in your gross income. So it will not be allowed as a
No, I'm saying
deduction. However,
even if he was let's say he was a partner, and so they cover him for, there's that cover that they do when someone's in business with you, so that if they die, you don't have like a loss of some sort. Would that also not fall under, would that also fall under Section 23?
It will be in terms of Section 11M. I think the what is this, the deduction that the person can get on that contribution, like in terms of protection. You just have to make sure that all those requirements are met. So when we did Section 11A, it's like we mentioned that Section 11A should be read together with Section 23, which says that the amount needs to be in the production of income. And then we later did specific deductions. Your specific deductions would be your deductions that are not in the, we call it the general deduction formula, which will be your specific deductions, your 11C, 11, and then those ones are based on the requirements of those sections. But this one is just like a general payout. So it would be considered in the context of Section 11A. And since it does not result in taxable income when paid out, it is not going to be taxable.
Okay.
It is not, they're not gonna get a deduction on it.
A deduction. Okay.
Yeah.
I get you.
Okay, and then we were then given our retirement annuity fund contributions. We know that we need to consider these contributions when we do our Section 11F. So let me just mention here, does not result in taxable income. Therefore, it's not deductible. And with some of these things, like you will only, like not only, but like you will, as the more you practice questions, the more you see what exactly is expected from you, and the more you can gauge what, like from exam technique perspective, what amounts can you generally get deductions for? Because I know with like your there's so many sections that you need to remember for your deductions, for your inclusions and stuff, but the more you practice, the better you get at it.
Okay.
Yeah. So I'm just gonna go through do you have any questions with regards to the analysis that we just did up here?
No, you
Otherwise,
were
I'm just,
answering me as I go.
okay. I think I don't know if it's your network or mine, but you cut a bit.
I think it's mine. Sometimes it's bad. And I think you can carry on. You answered a lot of my questions as you were going and reading.
Okay. So you then have your what is this? Your salary inclusion, obviously, your pension fund contributions which were made by your employee, which is a fringe benefit, as well as the pension the annuities that have been received on the pension. You have a long service award. It's going to be taxed, as well as the medical aid fringe benefit. Insurance payments are not deductible, as mentioned. It's because they are not in the production of income. They do not yield a taxable income. And retirement fund contributions. So you take all your total contributions, even the contributions that have been contributed by your employer, you have to take them into account when calculating your total contributions for the purposes of Section 11 Cap F. So the contributions that have been made by your employer are deemed to have been made by you for the purposes of Section 11 Cap F. You being the person in the scenario. So obviously you guys know that the Section 11 Cap F, it is limited to the lower of 3 amounts, and then the middle, like I memorize it as like, because I know that the specific sentence or sentences that speak to this limit is in the middle in the income tax act. So I just call it the middle higher. So, and then that middle calculation is limited to the greater of the remuneration and your taxable income. So in this case, our remuneration is the same as our taxable income, but that is not always the case. Your remuneration would be your amounts that meet okay, no, it's not, would be your amount that meet the definition of like a remuneration in terms of your, I think is it your fourth schedule? So there is a definition for your remuneration. So that's what you should keep in mind, that your remuneration is remuneration as defined, which is your amounts that you get as a consequence of employment. And you have to also consider your taxable income. Obviously, the lower of is that 77,000 that we just calculated up here. And since our total contributions are less than that, then we have to include, we can get the total Section 11 Cap F deduction. Right, and then you have your lump sum that has been received from the government pension fund. Amount that is included in gross income is going to be your A is going to be B divided by C being B being 25 years. I'll just look for the specific section from the income tax act and snip it and put it in the notes for reference purposes. So the amount of pension fund that is going to be included is going to be that calculation, and it's gonna yield us an answer of 850. And there were no contributions that were disallowed in terms of Section 11 Cap F. So your total taxable lump sum will be 850,952. And it will be taxed, they will both be taxed under a different tax table. So since the question just asked us to calculate your taxable income, you don't have to calculate any tax. So you have Jen, who retired on the 31st of October 2023 at the age of 60. Same thinking whenever you deal with a natural person. just to do a quick revision in your head. So this person is 60 years, important for the purposes of rebates as well as interest exemptions. Jen started working for a company at a young age. He was a member of the pension fund for his whole life. Jen had the following income, 30,000 per month. So they retired on the 31st of October. How many months is that for the year of assessment starting 1 March, ending 28 February? How many months is that? From 1 March to 31 October.
Is that not 8 months?
I think it's 8 months. So you have to calculate the salary over 8 months, and that will be included in gross income. And then pension fund, pension after retirement, 12,000 per month. This is after retirement, so it's from the after October, 12 months. I don't know how many months is that after October.
4 months.
Is it 4
until
months?
Until the current year of assessment will be
Yeah, 4 months. 12,000 per month included in gross income, as well as a lump sum that has been included. You know that you have to show the market that you know that a lump sum is going to be taxed under a different tax table. And now we have a purchased annuity, which is what we were talking about in the notes. So this is in terms of note 2. Jen used 100,000 from his life savings to purchase an annuity at the age of 50. So this is the investment that he paid to get this annuity. So this would be your A per that calculation that we did. And his life expectancy is 21.47 at that stage. In terms of the agreement, he was going to receive an annuity of 1.2 per month. So this is the total amount of money that he's going to receive for the totality of this annuity, 1.2 multiplied by 21.47, which is the life expectancy. This annuity is going to be for until he dies. So that the total amount of money that he will get from the annuity will be this calculation. So in terms of the agreement, he was set to receive monthly annuities per month from the 1st of November 2023. So C would be that. How many months is that from 1 November to 28 February?
It's 4 months.
So that would be 1.2 multiplied by 4 months. So to calculate, obviously, the capital portion on the annuity that he has received, this is what we are going to do, right? So we are going to include the annuities that he actually received in the current year, 1.2 times 4, and then you then exempt the capital portion that you would have calculated above. Are we together?
Yes.
Okay. And gifts from employees, 3, explains that Jen started cycling 10 years ago. He is known to be, he's a very keen cyclist and has participated in the 94.7 race for the past 5 years. His colleagues decided to buy him some new cycling gear, shirts, shorts, etc. They personalized it by printing on his name. So do you think that this amount that is this gift from from employees, from the colleagues, will be included in the gross income? Would it be income?
No.
Why is that?
Because it's not in the production of income.
Yeah, but it would, you're correct, it wouldn't be included in their gross income, right? But when we look at it from an inclusion point of view, we need to consider whether or not it is of a capital in nature. So you remember the gross income definition, amounts
Yeah,
received by or
definition.
accrued. Yeah, the definition. So when you deal with incomes, you have to deal with the specific gross income definition, and then when you deal with your expenditures, you deal with your general deductions formula. So because this amount it's not it's not it's capital in nature in a way because it does not result from his trade or anything like that. It does not result from his employment, which would be his trade, because if you could remember, trade has a very broad definition in terms of the Income Tax Act. It is just like it's a gift. Gifts are capital in nature. That's what you should know. Gifts from that don't result from that don't come about as a result of your employment, as a result of your employment contract. And I think this question has like a very good example because it then speaks to also the gift from your employer. And this is not to be outdone by employees. His employer decided to give him a spinning cycle for the recognition of 36 and a half years of loyal service. So this is a fringe benefit. What is this? The gift that has been received by Jen from the employer. However, this was given to him as a result of long service. It's a long service award. And in terms of the seventh schedule, with long service awards that have been received for long service after 10 years, I think you can get a 5%, no, a 5,000 Rand reduction on that fringe benefit. It's on your seventh schedule.
Yeah.
Yeah.
Okay.
So you just need to look for long services benefits.
Benefit. Okay.
So this,
Sorry, on the gift, because I remember I had asked when I was doing tax and second year for the gift from colleagues. When you say it's not because it's capital in nature,
yeah.
would that be similar to, because we had like I had a question about tips. If you're going to a restaurant and you tip someone, would that, and then I remember she stated that for because I would regard that as like a gift. And she was like, no,
Mm,
you can't regard that as like a gift because it still actually has, according to SARS, you actually supposed to put that and it has to be taxed as an
mm.
income. So
Because
for example, if the colleagues had given him, instead of the cycling stuff, had given him, let's say, uh, 10,000 Rand or whatever, would that would still be a gift because it wouldn't be capital in nature because his colleagues gave it to him. Or
mm,
but then if the employer had given him like the 10,000 Rand once off, would that also be regarded, because it's from the employer, would that
mm.
be regarded as a long service award um amount, or would
No.
that
So
differ?
like a long service amount is only like given when the uh, it is that amount is being given as a result, like for the recognition of being loyal to the company. That is a long service amount. And in the seventh schedule, it does speak to what is this, like the number of years, like
Of
being at a
years, yeah.
company for a certain number of years. But even if the employer had given that person like 10,000 Rand or any sort of gift, there is a
Mhm.
causal, there is a the causal of them receiving that amount is as a result of their employment, and that will then make it a fringe benefit. But
Uh,
the gifts from your colleagues are not as a result of your employment, but rather as like it's just because you have a relationship or with those colleagues. It's not due to an employment contract. It's not highly linked to your employment in a way. Like
okay.
I mean, there's a fine line because like your
Yeah.
colleagues work with it. It creates a bit of a confusion there, but it's not a fringe benefit.
So with this one here, because they said that part where it says 36 years of loyal service, service. Would the loyal service and the number of years be like a trigger of, okay, it would probably be like a long service award
Yeah, those are the
where you would
trigger,
implement the 5,000?
yeah. I
Okay.
think there's a period that the seventh schedule speaks to. I'll just look for it as well, and then we can look at it in our next session, or we can put it on the notes. I'd have to go and re-upload the updated notes. The notes are, by the way, they uploaded on the drive.
Okay.
So you then had they then speak to pension fund contributions of 2.4 and the retirement fund contribution of 27. So, and then medical aid expenses. So these pension fund contributions as well as the retirement annuity fund contributions will both be considered in terms of section 11 cap F, because as I mentioned, there is no distinction between these funds when you are thinking about the consideration in terms of section 11 cap F. So your total contributions will be your contribution for your pension fund as well as your contribution for your retirement annuity fund. So these are medical expenses that you would need to consider in the context of your your medical rebates. So medical aid contributions for the full year were 14,000, and medical aid expenses that are not refundable by the medical aid were 35,000. So Jan and his wife were involved in a car accident 7 years ago. He had a minor injury, but the injury left her with a disability as defined. So this will also affect the 6 can be medical rebate, like the type of calculation that you use to calculate the 6 can be medical rebate. So the question then says we need to calculate Jen's tax liability for the 2024 year of assessment. So you actually need to calculate tax. Yeah, you don't need to leave it at your taxable income. So let's just quickly go through the question. Not the question, the solution. So salary will be included in terms of paragraph C, and the pension after retirement, which were those what is it called, the annuities. And if you could remember, also we had a purchase annuity of 1.2 over 4 months, and we have to exempt from that a capital portion. The capital portion of that annuity has to be exempted in terms of section 10 cap A, and that will be the amount that you invested in the annuity as well as the amount divided by the amount that you're going to get throughout the period that you have this annuity multiplied by 4.8, and the net will be taxed. And your gift from colleagues are not remuneration because they are capital in nature, but your gifts that have been received from your employer will be included in your gross income in terms of paragraph E, and reduce from that 5,000 that is linked to the long service award. Are you still comfortable with it?
Yes.
Yeah. Again, I'm just not going to go through these calculations. Are you comfortable with them, or would you like me to continue to explain them? Or
No, it's fine.
yeah. Okay, so then you will then land at a taxable income of 252, and taxable income of 252, and you need to also then you need to consider your taxable amount on the lump sum. You take into account the actual lump sum that has been received, and you have to consider past pension fund allowances that were not allowed as a deduction. Did we have that? So you had, just need to see, I think we didn't consider this. So this is a retirement fund, 27,000, as well as your pension fund contribution. So you didn't have any disallowed allowances. And then did they give us past? I did not check that in when we were doing the triggers.
Not as far as I can see, they just have the
Yeah,
pension fund contributions and the retirement annuity fund contributions, the amount per
yeah,
month.
yeah. So you also have, that you also have to less your like retirement pension fund annuity that were not allowed as a deduction, as well as your retirement fund. So you need to consider that assessment separately. And then this will lend us to at a taxable portion of retirement fund being 1 million. So you obviously need to use the tax table that will apply to this lump
Proportional
sum,
lump sum.
taxable lump sum. And we can just quickly look at it on the tax tables that I've included. So this one, I think it will be in the last tier in the calculation. So this is the part of the calculation where this would fall. This is how you would then calculate your tax on those lump sums. And with your with your taxable income, it was 252, so it will be in this category when you calculate your tax on it. Are you comfortable with that, right? Like seeing where the taxable income or the lump sum falls on the tax table?
Yeah, you just kind of explained it to me a bit, but I'm trying to remember it also from the previous one that I did.
Okay. And then this will lead to you having a tax of 46,000, and you have your primary rebate. The taxpayer is not older than the age of 75, so they can only get a primary rebate. And for ease, I've included the primary rebates here for the current year. And as well as medical rebates. So your medical rebate is fixed at 364. And since he contributed for himself and his wife, and after the retirement, he continued to make contributions to the fund, right? So had they not said that he contributed to make contributions towards the medical aid, then they wouldn't be, the taxpayer wouldn't be able to get a medical rebate for the full 12 months. They're only getting for the full 12 months because they continued to pay for the full
Even
12 months.
after, from his own
Yeah,
pocket, even though he didn't have a contribution.
yeah, even after the, what is this? Even after the even
Retirement.
after retirement, yes. And then moving on to calculating your medical section 6 Hep B medical aid rebate. So you take your total contributions, which they had given to us in the question, the total contributions to your medical aid as well, and then less from that your section 6 Hep A medical rebate. And every time these calculations give you a negative answer, or you need to always keep it at 0. Add your qualifying medical expenses. Your qualifying medical expenses, they gave them to us at 35,000 and multiply that by 33.3%. So you calculate using that 6 Hep B calculation for people with disability, and it is the same for people over the age of 75.
Okay.
Yeah. So I think I'm just gonna do this last question for the purposes of time, because I think we kind of took time on our. It was a good session for me because it was very interactive. I enjoyed it, but I'm just gonna stop at 12.3, and the other ones you can do for yourself, and then you can ask me questions.
That's perfect.
Yeah. So you have Betty Happy, who's worked for Big Smile for 40 years. Same thing I preach. When you have a natural person, think about all the natural person's provisions. So she passed away on the 31st of January 2024. So that is like 1 month before the year of assessment ends. She would have retired on the 28th of February 2025 at the age of 65. Betty was married out of community of property. Her husband had already retired. Betty was the main member of her medical aid, or was the main member of a medical aid of which her husband is a dependent. So Betty contributes for medical aid for two people, her and her husband. So you have received the following information with regards to Betty's financial affairs for the year of assessment, 29 February 2023. A salary and a bonus of 500,000. So this salary and bonus would be included in Betty's gross income, as well as a lump sum from a pension fund. So Betty's estate received a lump sum of 1.2 on her death. She joined the fund 40 years ago when she started her work at Big Smile. On the 28th of February, there was a balance of 12,000 that Betty had not been allowed to deduct. So this will be your deductions in terms of is it paragraph 5 of the second schedule, because these are disallowed deductions. Retirement annuity fund income. Betty also joined a retirement fund when she started working. It matured when she turned 55. Thereafter, she received a monthly annuity of 6,000. So that's the one that they've included on our table up there is for 11 months.
Okay.
Betty did not receive any lump sum from the retirement annuity fund, so you don't have to consider this when you calculate your, your tax on the lump sum. Okay. Contributions to a pension fund. Betty contributed 8% towards that pension fund. Big Smile contributed an equal amount. So contributed 8% towards that fund, and Big Smile contributed that. So we have a fringe benefit as a result. Benefit. Yes, a fringe benefit, as well as this can also help us get the total deductions that Betty would have made to that fund. Betty further made voluntary contributions to the fund during the year to date. Betty made voluntary contributions to the fund during the year to the date of her death, and they amounted to 80,000 rand. So Betty paid 75%, representing 33,000 of her medical aid contributions for the period that she was alive. Her employer paid the remaining 25 for the period that she was alive. After her death, Big Smile carried on contributing to the monthly, to the same monthly amount for her husband, and the family had no other medical costs. So this obviously affects as well your fringe benefit up until the date that Betty passes on, because it wouldn't be a fringe benefit after she passes on, because it wouldn't be a fringe benefit. So let's quickly go through the solution. So your salary, those are the easy stuff. You know that it will be included in her gross income, as well as the retirement annuity fund income. The pension fund as well will also be included in Betty's gross income because it was contributed for by the employer. And the medical aid benefit, what the employer paid. So Betty paid 33,000, which was 75%, and of that, the employer paid 25%. So we have to calculate the medical aid benefit for that. And the employer then made a medical aid contribution when the person was deceased, and that payment for the deceased is not going to be included in the gross income as a fringe benefit. Are you still with me?
Yes.
Okay, so you then have to calculate your, your total contributions. The total contributions will be all the contributions that were made by Betty in the current year. And that will lead to us having an amount of 160, and obviously performing this calculation. I'm going to go through it. Lump sum benefits, lump sum pension fund that has been received by Betty was the 1,225, and they did tell us that there was 12,000 that was disallowed as a deduction from the previous pension fund. So that will lead to us having a taxable retirement fund of 1,213,000, and the total tax that is payable on the actual taxable income will be this as calculated per the tax table. So you go to the tax table. Let's do this assessment for the last time. You go to the tax tables and you check which tier does it fall under, and it obviously falls under this one, and this will be how you calculate your taxable, your tax on your taxable income. And since Betty is younger than 65, only gets a primary rebate. Primary rebates are apportioned for days, for the number of days that the taxpayer was alive. So this is something to remember. Every time there's a deceased person, you have to calculate the rebate based on the number of years that the person was alive. Are you still with me?
I'm with you.
Okay. And then you have your medical aid rebate. You see, this is not the same as like the last question that we did, because they didn't tell us, because this person died, they obviously did not make any medical aid contributions after
The death.
that 11-month that they died.
Just a question for the medical scheme. So because of the rebates and stuff, when someone dies, I know with certain medical aid from government especially, is that the company will carry on contributing, and then the other person, the whoever is now the new holder or the new main member that's been allocated by the medical scheme, will be responsible for the remaining amount that's not being subsidized or contributed on behalf of the employer. Does that amount now, the person who's paying, does that fall under their income, or who does it fall under? Who then pays for that, who gets the tax rebates? Would that be the
The
new
take,
main member?
I'm not sure, but I don't think it should be the new main member, because this is not done on behalf of the new main member. It's done, it's technically
Based
being
on
done.
the deceased.
Yeah, it's still it's still done for the deceased, because it's just for the benefit of the deceased dependent.
Okay,
But
so
I'll
what
just make
I'm,
sure.
but
But
I'm asking
it's
because if, for example, the person was getting because of the deceased, and then the remaining remaining beneficiaries would then get like an income from whatever. Let's say they had a fund where it pays an annuity every single month on their carrying on, and then they pay the remaining amount that from the contribution. They are part of the contribution. Who then gets the rebate of that amount, because the other person's deceased, but the medical aid is basically still carrying on, and they also
so
get like an amount.
yeah, but if you could think about it, that the reason why, let's say, for example, someone's dependent, and they pass away, and I still get like medical aid benefits by virtue of being that
Dependent.
person's dependent.
Mm-hmm.
That contribution is not done on my behalf, but rather the person I depended on, because the reason for that contribution is because of the deceased.
Mm-hmm.
Yeah, it's not for me technically, because it's done for their benefit. It's
Mm-hmm.
like still continuing to give the deceased dependent any income. That is not done
Mm-hmm.
on the behalf of those people, but rather the behalf of the deceased.
So basically, what I'm trying to ask is that since it's being done on behalf of the deceased, what are do the tax implications still remain the same, or they differ because now for example, the 364 that's being paid, If you
Mm,
after the person has passed away, and then from the 1 month that they've passed away within the assessment year, they passed away in January, and then for the February, that 1 month, who then pays, or what happens when it comes to SARS, or when it comes to tax purposes, what do they do with that 1 month for that rebate? Because the person is still
mm.
now carrying on with the
The
income, even though the initial person is deceased, and the company is still contributing, even though the initial person is received. Because as much as
yeah.
it's not a fringe benefit anymore, because the person has been deceased, what is the tax implication in that? Then who does the tax shift, or does it no it's lower, or it's
I,
not
the
non-existent?
the text wouldn't shift, but the people that, like in this case, the deceased is not anymore, so they
Okay.
can't get any medical rebates on this contribution.
On this contribution,
And
yeah.
the employer will still, like in the context of, let's say, a pension fund, and they still contribute, like okay, maybe towards a fund, they still continue to contribute towards a fund for a deceased person.
Mm-hmm.
The deceased person tax ceases on the day that they die,
Mm-hmm.
and it will not fall onto the next person, but their
Mm-hmm.
estate.
Okay. The estate will pay.
Yes, so the estate will, so now we will not be having the
A natural
individual
person anymore.
anymore, but the
Mm-hmm.
deceased estate.
Okay,
Mm,
that's what I wanted to find out. Okay, that makes sense.
mm.
Okay.
All right. So now you have your medical rebate as in terms of section 6 A, and then your 6 B, because this person was not disabled. So you calculated using the general um 6 B calculation. So I suggest that you keep notes of like a different distinction between how would you calculate your 6 B if the person is disabled or older than 65, and if
Okay.
they are not. Yeah, just
Okay.
keep it here so that you don't forget. Yeah, and then last but not least, calculation the tax on the lump sum. Same thing, you check which tier of the table do they fall under, and then move accordingly to
Okay.
calculate you on the, yeah. Yeah, this was a great
Okay.
session. I had a nice session. I don't know.
Yeah, yeah, I had a great one as well, because you explained a number of things,
Yeah.
and you clarified